everyone, and welcome to the August 2021 edition of the Economist Intelligence Unit's Global Outlook video. My name is Agathe Demarais, and I'm the Global Forecasting Director at the Economist Intelligence Unit. I'm joined today by Cailin Birch, our Global Economist and Lead Oil Analyst, and Adnane Allouaji, an analyst in our Middle East team. And today we're going to discuss our latest oil price forecasts and what they mean for Middle East and Africa countries. So without further ado, I'm going to turn to you, Cailin, and perhaps to do a scene-setting question to start with. Can you please let us know, we're at the midpoint for 2021. How do things look like regarding global growth at the moment?
Well, as we all know, it's been a bit of a volatile year. That might be quite an understatement. We've seen sentiment really been on a bit of a roller coaster since the start of 2021. Expectations for global GDP growth really soared in the first half of the year as the vaccine rollout started to make considerable progress in some of the major economies of the world, and powerhouses of the global economy, most notably the US and China, rebounded much faster than most other economies from the crisis. So we're in a bit of a heady day moment of the actual economic rebound from the crisis. But of course, that couldn't last forever. And we've seen recently some clouds starting to gather on the horizon. And that's mainly because of the emergence of new and more infectious COVID-19 variants, but also because of a slowdown that we've seen in the vaccine rollout in some countries as the level of vaccinations has started to taper off. And also major vaccine delays in a lot of economies, primarily the emerging and developing world, that were always well behind the curve in terms of obtaining supplies and delivering them. And that all suggests that actually the recovery in the global economy be a lot more gradual than maybe many had expected at the start of this year. Now, we've always expected to see quite a disjointed and gradual economic recovery. So that's more or less in line with our view. We've raised our forecast slightly over the course of recent months to reflect now global growth of 5.4% in 2021. That's effectively enough to put the global economy back on a par with its pre-coronavirus levels by the end of this year. So a full recovery, kind of in terms of the headline figures by the end of 2021. But of course, there'll be some big discrepancies within that, both between different regions and among, or rather within certain regions. But nonetheless, it's still a recovery story, one that's going to drive really strong commodity demand this year and probably next as well.
That's a perfect hook for my next question, since you're mentioning commodities. So we've seen that oil prices have recently reached a 3-year high. What do you think is behind this trend, and how long will it last?
Well, I think probably what we've seen recently is a bit of a one-off. So July was a weird month for a lot of reasons. And we're probably going to settle back into that range-bound view that we've expected to dominate the oil market over the course of the coming weeks and months. And that range of between $60 to $70 per barrel still feels quite right to us, as global oil supplies are still quite comfortable. OPEC Plus still has considerable oil reserves that they're choosing not to tap into. And it looks for the moment that they're going to continue to carefully match its supply increases against a gradual recovery in oil demand. So still kind of an environment of caution with regard to OPEC Plus. Of course, that forecast kind of for range-bound, more or less stable prices means that OPEC Plus numbers have got to stay on the same page. And as anybody who watches OPEC knows, that is an enormous ask. And the price spike that we saw in July actually was driven by a dispute that was mainly between some of the major actors in OPEC. So that's notably Saudi Arabia and the UAE, though several others kind of were part of the mix as well, over production volumes for the rest of this year. And we think that essentially that dispute was less about their actual long-term view of market fundamentals and more an effort to position themselves for market share as oil demand starts to recover. So something of a superficial dispute, if I can characterize it like that, rather than a different view of how the oil market is moving or where the appropriate level of production is. So we had expected that to be a temporary dispute, and indeed it was resolved 2 weeks later. So it was a bit of a temporary blip for the oil market, albeit quite an uncomfortable one. But now that a new deal is in place from OPEC, we have seen oil prices starting to come back down to levels that we'd seen prior to that. And those market jitters have been worked through. So we now expect oil prices to stay again around that $70 per barrel mark for the rest of this year, and indeed a lot of next year as well, as we see that cautious approach from OPEC. Now, of course, there are a lot of risks to that forecast, including the shale outlook for the United States and the trajectory for oil demand and GDP recovery in 2021. But on the whole, we think the oil prices will still hover around that range, supported by the fact that OPEC has more power to influence the market now than it has in really decades.
And so maybe going back to the global economy. So we're talking about oil at a 3-year high. We were taking a look internally at our commodities forecasts, which you run, and we're seeing 30% jumps in industrial raw material prices and also food, feedstuff, and beverages prices this year. What does it all mean for inflation? Should we be concerned about a spike in inflation this year?
It's definitely a worry. Undoubtedly, a 60% jump in oil prices, and as you said, 30% in other industrial goods is going to create shockwaves. We'd be kidding ourselves to say that wasn't the case. And we do expect global inflation to reach a high of 4.8% this year. That's the fastest rate in a decade. But it's also worth noting it's also the fastest rate in our 5-year forecast period. So we still do expect those pressures to be largely temporary and limited to 2021 as we see the initial rebound from the crisis and a recovery in GDP. We expect a lot of the factors that are driving those price increases, including oil price growth, but some other things like the jump in freight rates and supply-demand mismatches as major economies reopen to start to subside in 2022. So really, inflation, a huge risk, but for now, we don't expect annual inflation to be serious enough to delay the economic recovery this year. And we expect it to start to subside next year. However, I would caution that, as always, that if oil prices were to rise more sharply than we currently expect, say above $75 per barrel, that could set us off in a slightly more worrying trajectory.
Thanks so much, Cailin. And I'm going to turn to Adnane now to discuss what our oil price forecasts mean for Middle East countries. So with this OPEC Plus agreement now in place, Adnane, what would you say is the economic outlook for Middle Eastern countries in 2021, 2022? And I appreciate that's a really broad question.
Yeah, so growth in the region will move largely in line with global oil prices. In 2021, the growth in oil revenue will be constrained by the partial nature of the recovery in global hydrocarbons output. We expect real GDP growth across the Middle East and North Africa to average 3.5% in 2021, up from an average recession of 4% in 2020. And most growth will be supported strongly by fiscal spending. With pandemic-related spending needs likely to remain elevated, fiscal pressure will ease only modestly in the region. International oil prices are expected to remain elevated, as Cailin said, in 2022. And as the global economy continues to recover from the pandemic, real GDP growth is expected to average 4.2% in 2022, helped by the continued rollout of COVID vaccines across the region. In terms of fiscal pressures, most of the Gulf states have substantial sovereign wealth funds that they can tap into and ongoing access to international borrowing, which will allow them to weather any fiscal pressures in the medium term. On the other hand, poorer Middle Eastern countries will have fewer fiscal stimulus tools to play with and will continue to rely on their wealthy neighbors for support.
So actually something that we've been hearing a lot is economic diversification for Middle Eastern countries. And I think this has been ongoing in terms of discussions for perhaps more than a decade. What's your take on this? Is this realistic? How do our oil price forecasts have an influence on this?
Yeah, so the 6 Gulf Cooperation Council members comprising Bahrain, Kuwait, Oman, Qatar, Saudi Arabia, and the UAE have set targets to dramatically increase the share of renewables in their hydrocarbons-dominated energy mix over the next decade or so. However, their credibility and progress on implementation will vary widely. International pressure to decarbonize, conducive climatic conditions, and a decrease in costs of solar and wind power are common factors. Other motivations differ between the countries, with some focused purely on replacing gas in domestic power generation, and others looking to create a strong localized renewables sector as part of a wider economic and export diversification strategy. GCC members were forced to slow down their economic diversification drive during the pandemic and will now need to accelerate investments to catch up on lost time. Several states have recently launched plans to indirectly export clean energy through the development of a hydrogen industry as part of preparations for a long-term downturn in demand for their fossil fuels. We expect some governments, notably Saudi Arabia, to miss their headline targets. but the GCC renewable sector will expand rapidly over the next 5 years, creating huge business opportunities. Despite a significant economic diversification drive by the GCC members, oil revenues will continue to be the backbone of GCC economies, particularly as their investments in economic diversification are financially huge. As such, GCC members will continue to rely on oil revenues to sustain and fund these big ticket development plans.
Okay, so still reliance on oil revenues to fund big ticket infrastructure and development plans. I think that's the main takeaway. Thanks so much, Adnane and Cailin. We're coming to the end of our video now. You can always find our latest analysis on our website, www.eau.com. Keep an eye on our latest analysis on commodities or also the impact of the coronavirus pandemic on Asian and North American supply chains, or also our timelines for global vaccination. And you can also follow us on Twitter at the EAU or on our personal Twitter, and hopefully our handles which are nicely on your screen. Thank you very much for watching us today. Stay safe and see you next month. Goodbye.